Many business owners look at their tax bill and immediately wonder what it says about them or their business. If seeing that number triggered concern, confusion, or second-guessing, this video is for you. A tax bill feels definitive. It arrives as a single number that seems to summarize an entire year of effort, risk, and responsibility. Because of that, owners often treat the tax bill as a judgment instead of what it actually is. Understanding what a tax bill truly reflects helps owners interpret it more accurately and avoid drawing the wrong conclusions. In this video, we're not discussing how to reduce your tax bill, optimize deductions, or change your filing strategy. We're also not offering tax advice or evaluating individual situations. We're simply going to explain what a tax bill actually represents and what it does and does not say about your business. We'll start by breaking down what a tax bill is measuring, then look at why it often feels personal to owners, and finish with a clearer way to interpret that number without self-judgment. This is about understanding, not reacting. A tax bill measures past activity. It reflects revenue earned, expenses recorded, timing of income and costs, business structure, and filing status. It does not measure effort, stress, quality of decisions, difficulty of the year. That distinction matters. When owners forget that taxes are backward-looking, they treat the number as feedback on how they are currently performing, which is inaccurate. For owners, money and responsibility are closely tied. So when a tax bill is higher than expected, it often triggers thoughts like, I should have done something differently. I missed something. I wasn't careful enough. But a higher tax bill usually means more activity occurred, not that something went wrong. The emotional reaction comes from interpreting the number without enough context. The misunderstanding is believing, if this number is high, I made a mistake. In reality, tax bills rise for many neutral or positive reasons: increased income, a busier year, deferred expenses, structural timing differences. Without understanding those drivers, owners absorb the number as criticism instead of information. Here's the calmer way to think about it. A tax bill is not a verdict. It's a summary. It tells you what happened, not whether it was good or bad. When owners treat the tax bill as data instead of judgment, the emotional weight drops. That clarity allows better conversations, better planning later, and less stress in the moment. If your tax bill caught you off guard, that doesn't mean you failed. It usually means the year was more active, complex, or uneven than it felt day to day. In the next episode, we'll talk about why profitable businesses still feel unprepared at tax time, and why that experience is far more common than most owners realize. Please like this video if you have enjoyed. Every like encourages us to create helpful content. Thank you once again for watching. Have a blessed day,